The Zacks Rank, value, momentum, growth, and income all factor into Zacks Rank buys.
An insurance company popped up on the growth and income radar, and our growth and income strategist, Todd Bunton, wants you to know more about it. So he's here with me now. I think you and I have talked about this in the past, Old Republic International?
We have, yeah. So they're an insurer. They operate primarily in two segments. The first being general insurance, your property and casualty lines, workers' comp, and also they have a title insurance business.
Oh.
And business has been good for them. The company recently delivered a very solid beat in October, and that was driven in large part by higher premiums, so they're able to increase the rate that they charge for their insurance, but also stronger underwriting profits across many of their lines. One of their better performers last quarter is workers' compensation. So the claims ratio dropped on that, and their overall expense ratio declined. So that helped boost profits, and that also prompted analysts to revise their estimates significantly higher for both this year and next year. You can see here the agreement and magnitude of consensus estimates. That's why this stock is a Zacks Rank #1 strong buy. It's because these numbers are so strong. So you can see the nice increase in consensus estimates for both 2015 and 2016. Strong growth projected over the next couple years as underwriting profits are expected to continue to improve, and management expects to be able to charge higher premiums as well. So business is improving for them, and I would say one kind of option for these guys is higher interest rates. They would actually enjoy higher interest rates because they get to invest the premiums that they take in at higher rates, and that's really where a lot of their profit comes from, is from that investment income. So a higher rate environment is good for them. Their portfolio durations are relatively short, 4.3 years, so they're not too interest rate sensitive either.
Okay.
And on top of all that, they pay a dividend that yields over 4%.
Yeah.
Very solid, stable dividend.
I had to look 3 times at that number to be sure I was reading it correctly.
It's very solid. And as you can see, it's one of the best in the industry as well. You can see MetLife, Prudential, they both yield less than 3%. And Old Republic has actually increased its dividend at over a 3% compound annual growth rate over the last 10 years. And they're expected to pay out about 60% of earnings this year in the form of dividends. So that dividend looks very, very safe. And like I said, they're in some more predictable insurance lines like workers' comp, so their cash flow is pretty steady, pretty predictable. So I'd say that dividend is pretty solid there. And all that at a pretty reasonable price. They trade at less than 13 times forward earnings. Now that's not quite as cheap as some of their peers. Some of their peers trade below tangible book value. Old Republic's at about 1.4 times tangible book value, but very reasonably priced on an absolute basis. And one of the reasons for the premium amongst its peers is because they've been operating so well. Like I said, they have the solid underwriting performance and that solid dividend as well, and positive earnings momentum. So they had that nice beat and increase in consensus estimates. So I see solid total return potential from this name over the next 6 to 12 months. And like I said, if interest rates go higher, that's just added bonus right there.
Yeah, all right. Do you own it?
I do not.
All right, check out more stock information, picks, stock picking strategies, commentary, all on our website, Zacks.com. If you're not there already watching this video, get on over to the homepage, because that is where you can link to it from. If you're watching these videos on YouTube, just want to remind you, don't forget you can subscribe to them there and comment on them. With Todd, I'm Terry Ruffalo.